Welcome to Penny Flow, where we talk about money, wealth, investing, and management. In today's video we will be talking about the stock market. Please make sure you stay tuned to the end of this video. Stock market for beginners. Investing is a way of setting aside money while you are busy with life, and having money to work for you, so that in the future you can fully reap the rewards of your labor. Investing is a means to a happy ending. The easiest way to start investing in the stock market for beginners is to put money in an online investment account, which can then be used to purchase stock or stock mutual funds shares. An investment is an asset or item purchased to produce revenue or appreciation. An investor, for example, will buy a monetary asset with the expectation that the asset will provide revenue later or sold for a profit at a higher price. You will start investing in the price of a single share with several online brokers. Here's how to invest in stocks. Number 1. Manage your stock portfolio. As an individual, worrying about daily fluctuation will not do much to your health and also your portfolio. There will certainly be times when you will need to check in on your stocks or other investments. If you follow the above measures to buy individual stocks, you will want to review your portfolio many times a year to ensure that it is still in line with your investment objectives. If your stock portfolio is only in one sector or industry, there are a lot of risks that may be involved. Consider purchasing stocks or funds in another sector to build more diversification. It helps to reduce the risk level. Finally, pay attention to the diversification of geography as well. This simply means investing in various countries may be favorable. Number 2. Focus on long-term investment. Investing in stocks involves learning various strategies. Some of the most active investors have done nothing more than stick to the fundamentals of stock investing. Warren Buffett has famously said that a low-cost S&P 500 index fund is the best investment most Americans can make. Choose individual stocks only if you believe in the long-term growth prospects of the business. The best thing to do after you start investing in stocks is to avoid looking at them. It is nice to stop the practice of constantly checking how your stocks are doing several times a day. Number 3. Set a budget for your stock investment. New investors often have two questions in this step of the process. How much money do I need to start investing in stocks? The amount of cash you need to purchase an individual stock depends on how costly the shares are. Share prices can vary from only a few dollars to thousands of dollars. An exchange-traded fund, ETF, could be your best option if you want mutual funds and have a limited budget. Mutual funds also have a minimum of $1,000 or more, but ETFs trade like a portfolio, meaning you buy them at a share price less than $100 in some cases. Number 4. Know the difference between stocks and stock mutual funds. Stock mutual funds, or exchange-traded funds. In a single transaction, mutual funds let you buy small pieces of several different stocks. Index funds and ETFs are a form of mutual fund that follows an index. You also own small parts of each of those businesses when you invest in a fund. To construct a diversified portfolio, you can put several funds together. Notice that stock mutual funds are also called equity mutual funds. Individual stocks. You can buy a single share or a few shares as a way to dip your toe into the stock trading waters. If you're after a particular company, it is possible to create a diversified portfolio of many individual stocks, but it needs large investment. The advantage of mutual funds is that they are naturally diversified, reducing your risk. A portfolio comprised entirely of mutual funds is the clear option for the vast majority of investors, particularly those who invest their retirement savings. But as some individual stocks, mutual funds are unlikely to grow in meteoric fashion. The advantage of individual stocks is that a wise choice will pay off handsomely. but the chances are extremely slim that any individual stock would make you wealthy. Number 5. Open an investing account. Generally speaking, you need an investment account to invest in stocks. This usually means a brokerage account. For the hands-on types, opening an account through a robo-advisor is a sensible option for those who needs help. Both brokers and robo-advisors allow you to open an account for very little capital. An online brokerage account is likely to provide the fastest and least expensive route to funds and several other investments. You can open an individual retirement account with a broker, also known as an IRA. You can open a taxable brokerage account if you are not saving enough elsewhere for retirement. Based on factors such as costs, trading commissions, account fees, investment selection, look for a good selection of commission-free ETFs, and investor research and tools. You will want to evaluate brokers. A robo-advisor offers the advantages of stock investing, but does not give its owner complete investment management. During the onboarding process, these firms will ask you about your investment goals and then build you a portfolio design. This can sound expensive, but the management fees are generally a fraction of the cost of what a human investment manager will charge. Most robo-advisors charge about 0.25% of the cost. And yes, if you wish, you may also receive an IRA from a robo-advisor. Number 6. Decide how you want to invest in stocks. There are many ways to view investing in stocks. Choose the choice that better reflects how you want to invest and how you would like to pick and select the stocks you want to invest in. An excellent way to develop wealth is to invest in stocks. Particularly during times of market turmoil, stocks are a safe investment for long-term investors. A stock market downturn simply means that many stocks are on sale. You could be a good candidate for a robo-advisor, a service providing low-cost investment management. Virtually all of the major brokerage firms offer these services, which, based on your specific goals, invest your money for you. Number 7. How much should I invest? Many smaller investors who drip feed regularly in small amounts will do much better than those who simply throw a large sum into the market. As a rule of thumb, you can never spend more than you can afford to lose. So many people believe you need to have a lot of cash to be able to spend in the stock market. This is because, if you have so much of your money invested in the event of a stock market crash, you might risk losing a big chunk of your income. For at least 5 years, several financial advisors would recommend you invest. This gives enough time to ride out any market bumps that may make you lose a lot of money. Note: if you have little savings, your financial health may be poor for gambling on stock markets. However, if you've built up a backup and are fed up with low savings rates, putting a piece of it on the stock market could be a good way to try to earn greater returns. Have you ever tried investing in stocks? If yes, what are your outcomes? Leave a comment below.